G'day everyone, and welcome to this deep dive due diligence webinar, we call them. And we're looking at Tamboran Resources, ASX code TBN, a company that only listed back in July last year. It's got a market cap of around 212 million. Now, for this presentation, we'll break it up into 4 segments. So ideally, the questions you ask, you can ask through the box provided. Ideally, those questions are in relation to the slides that we've spoken about or been presented to us by Joel. Now, so type your questions in the box provided. Now, for full transparency, Corporate Connect, which is our research partner, we will be releasing research on Tamboran Resources in the very near term. Now, we have today with us Mr. Joel Riddle, who's currently in downtown New York. It's about 10:30 at night. Now, Joel joined Tamboran Resources as CEO back in 2013, has more than 17 years experience in the upstream oil and gas industry, and was previously with Cobalt International Energy, where he worked closely with executive management in the initial evaluation and implementation of the exploration growth strategy in the Gulf of Mexico and West Africa, playing an instrumental role in Cobalt's $1 billion initial public offering in 2009, and subsequent capital raisings after that. Joel, thanks for your time this evening. We know it's late in New York. Over to you.
Thanks very much, Tim, and I appreciate Share Cafe hosting this due diligence seminar. And I want to welcome everyone who's joining us from Australia to hear about what I believe is one of the most exciting growth energy stories in Australia equity markets in the next 3 to 4 years. So what I plan to do today is start out with a little bit of introduction around the company, who we are, and then get into a little bit of the company strategy, where our asset sits, and then a little bit of detail around the activities that the company will be progressing over the next 18 to 24 months to create value for our shareholders. So starting out with a little bit of summary on the company, really 5 key points that I'd like to underscore here. First, we're a company that is 100% focused on developing the Beetaloo Basin. For everyone not familiar with the Beetaloo Basin, this is a very large prospective gas shale basin in the Northern Territory, situated about 400 kilometers south of Darwin. This is a basin that looks very similar in scale and quality to the Marcellus Shale, which is widely known as the most prolific shale basin in the world. In addition, this basin has very low CO2, on the order of 2 to 3% in situ in the reservoir. So when we produce, the company will be focused on developing a net zero gas stream by integrating renewables, integrating batteries, and also including offsetting this carbon with carbon offsets. There's a couple of things that we'll be progressing as part of our development plan. We've had some significant de-risking in our assets. The company will be focused on progressing our pilot development on our EP136 block by the end of 2025. This is 100 million cubic feet a day of pilot production that we will target the East Coast gas market. At a conservative $10 gas price, this would equate to around 400 million in revenue per year starting in 25. And then from there, we'll look to scale up into a full field development, which will target initial production in our full field production of 101 BCF a day, which if you assume an $8 long-term gas price, that would equate to around 3 billion in revenue per year. So again, 400 million target in revenue by 25, scaling up to 3 billion in revenue by 28, 29 timeframe. There's a couple of key advantages that the company has that really sets us apart from our peers and which will allow us to accelerate this development. First is the high quality asset mix situated in the core part of the basin. This is where the rock properties are 2 to 3 times as good as in other parts of the basin. It's also where the pressure, the reservoir pressure is very high, which nets out to being equivalent to allowing the company to produce very high productivity wells, both on production and reserves per well. Second is our partnerships. We have progressed a midstream partnership with Gemina, who's the second largest midstream company here in Australia. This partnership will allow us to access the Northern Gas Pipeline for our pilot development, and will give us a right of first refusal to develop that first 100 million cubic feet a day into the East Coast market by 25, 26. And third is really our expertise, both at the board level, management level, and at the operating team level. We've been very cognizant of importing U.S. shale expertise that have been developed over the last 12 years and importing that into the Beetaloo Basin on day one with our people. I'll talk about that a little bit later in the presentation. Again, Tamboran Resources is a publicly traded company on the ASX, listed code TBN. We traded around a $210 million market cap. We have $55 million in cash on hand. This is after completing an IPO in middle of last year and completing a secondary offering in November. In total, we've raised over $95 million in total capital over the last 12 months. And you can see our shareholder list on the bottom hand right of the slide. It's a very tight shareholding that we have. Around 80% of the shares are held by the top 20 shareholders. We spent a lot of time attracting some of the most quality funds out of the US, including Baupost, which has a 17% shareholder in Tamboran. Baupost is a $35 billion fund out of Boston. Sheffield Holdings is the personal money of Brian Sheffield. Brian Sheffield was the founder of Parsley Energy, a highly successful shale player in the Permian Basin. Brian Sheffield came in with a $20 million personal investment in November of last year to lead our secondary round. He's a 10% shareholder. And lastly, Lion Point Capital is another fund out of the US based here in New York, 9.3% shareholder. In addition, our board and management hold about 10%. So we're very much aligned with all the shareholders here at Tamboran Resources. A little bit more around the people. One thing I'll say is in any large development project, there's really two things that really provide key success factors for a development plan. One is around capability, attracting people who have underpin a foundation and U.S. shale expertise for our business plan. And two, guys that actually had executed similar business plans like what we're planning to execute here at Tamboran. There's no one better suited to lead our company than Dick Stormberner. Dick is 35 years in the oil and gas industry. Previously, he's the founder of Petrohawk Energy, who were very early in the Eagle Ford Shale and ultimately sold to BHP Billiton in 2012 for $12.1 billion. When you look at what Dick was able to accomplish at Petrohawk, it's essentially a laydown blueprint of our business plan that we're going to be looking to develop over the next 3 to 5 years at Tamboran. Fred Barrett is also on our board. Fred's a 12 years chairman, CEO of Bill Barrett Corporation, another highly successful shale player in the US, where he was early in the Peons play in the Rockies. Both Fred and Dick are geologists by background, so we tend to look at the rocks in a very careful way before investing. And we're very fortunate to have attracted Dick and Fred to our board. As Tim mentioned up front, my background's 25 years in the oil and gas industry. I'm a petroleum engineer by background, again, stints with Exxon, Unocal, Chevron, and Cobalt International Energy. And I've been with Tamboran now coming up on 9 years. Underneath, on the executive team, we have Eric Dyer, our CFO, over 15 years an investment banker here in New York. And we've recently hired Farron Thibodeau as our chief operating officer. Farron is 40 years in the oil and gas industry. He led the business for Apache in Australia out of Perth. And most recently, before joining the company, Farron was responsible for guiding Apache's business in the Permian Basin, a very large shale play in Texas, where he's responsible for $1 billion budget and running about 14 rigs. So we're very fortunate to have attracted someone of Farron's quality to our executive team. And sitting underneath Farron is an operating team that we recruited out of Pioneer Natural Resources. This is a very high quality team that has a tremendous amount of experience in all the key basins, all the key shale basins in the U.S., in the Permian, the Eagle Ford, the Barnett, and the Marcellus. This team is responsible for drilling over 5,000 horizontal wells in each of these shale basins and have over 200 years of combined U.S. unconventional experience. So again, the strategy for our company is to take this experience that had been developed in the U.S. and U.S. shale over the last 12 years and import that into the Beetaloo Basin from day one. So what I want to do now is get into our strategy, what we're looking to do for the company over the next 3 to 5 years. Before I move on, maybe I'll stop there and take any questions on the company. Over to you, Tim.
Right, thank you. Yeah, a few questions here. I suppose we've got a really impressive board and a really impressive operational team. What attracted them to Tamboran in particular? I know you've kind of gone on this, but what about the Beetaloo Basin in particular? Where's their focus and what excites them the most?
Yeah, look, this is a team and a board that has experienced unlocking a basin, a shale basin, much like the Beetaloo in the U.S. Dick with his experience in the Eagle Ford, Fred with his experience in the Piceance. This team out of Pioneer, have experience in all the key additional basins, and there's nothing more exciting for a technical and operating person than unlocking a basin. And so each of these guys did a lot of due diligence before joining Tamboran, and they realized that the Beetaloo Basin, particularly where we have assets in the core part of the basin that look very similar to the Marcellus, have a very high chance of working in a commercial way. And, to answer your question directly, it was about the rocks and how these rocks look very similar in signature to the Marcellus shale.
In regards to that, we've got probably a technical question here. What differences have you encountered with the properties and productivity of the Valkyrie shale with the Markless shale in the US? Does this mean there is a lot more trials to optimize?
Look, when we look, I actually have a slide on this exact
sure.
Answer, but I'll answer the question now, and we can reference it later on in the deck. Look, on every key rock property, that being porosity, gas saturation, TOC, clay content, this looks very, very similar to the Marcellus shale. It sits right on top of all those rock properties. The only difference is it's about 60% thicker. The Beetaloo is about 50% deeper, so it's higher pressure, and it has about 80% more gas concentration, otherwise known as gas in place. So this is, again, all sets up for very high productivity on production per well and high productivity of reserve recovery per well. This is, again, what really excites me and the rest of our team on being able to perform what we believe is latest generation completion designs on a very high productivity rock.
Joel, I'll let you get into the strategy and the more technical details now.
Great. Thanks very much, Tim. So what I want to do now is introduce the strategy for the company. Again, the two assets that we own in the Beetaloo Basin have incurred a significant de-risking over the last 6 months, which really puts the company in a place where we're moving out of the exploration appraisal phase and into the development phase. And so our goal is by the end of this decade to develop a BCF a day out of the Beetaloo Basin. We would like to progress that very large development in a phased way. Over the next 18 months, we will be focused on our EP 136 block, where we'll be looking to mature a 2P reserve of a TCF. And that will underpin our pilot development, where we would envision ramping up initial production by 2025 to 100 million cubic feet a day. Again, at $10 gas prices, this would equate to 400 million in revenue by 2025. And then be in position following the initial production of this pilot development and leveraging the learning curves from drilling the first 20 or 30 wells to create this pilot, to sanction and be on track to produce a BCF a day by the end of this decade. The target market for the pilot development is the East Coast gas market. And then the target market for this BCF a day, ultimate full field production, will target the backfilling of multiple LNG plants. There's 2 LNG plants that are currently producing to our north and 3 LNG plants that are producing to our east. Out of those 5 LNG plants, three of those plants are projected to be very short gas in that 2030 timeframe. So again, if you assume a very conservative $8 gas price, that BCF a day would equate to a $3 billion in revenue per annum. So very significant size and scale potential for this development plan as we move over the next 5 to 10 years. As a backdrop to this strategy, we believe that we are coming into a place in gas markets in Australia, both on the domestic and on the LNG side, that are incredibly favorable to upstream producers, particularly producers like Tamboran that will be maturing 2P reserves and bringing new supply into the market. This is really driven by 2 key factors that has occurred over the last 5 or 10 years. One is a complete underinvestment in new gas developments. This has resulted in potential shortfalls in this domestic market over the next 3 to 5 years that could amount to 500 million cubic feet a day of shortfalls or more. In addition, as I mentioned on the previous slide, we're not just focused on this structurally short domestic market. We also will be targeting this BCF a day to backfill existing LNG plants that are, again, projected to be short gas on the order of 1 to 2 BCF a day by the end of this decade. In addition, to add to the macro backdrop, the federal government in Australia has taken note of these shortfalls and has incentivized operators like Tamboran to, accelerate the development of the Beetaloo. The Beetaloo has been deemed as a strategic basin by the federal government. And the federal government's gone so far as to put $50 million of subsidies in place to offset new exploration gas drilling for this year. And Tamboran will be taking advantage of $7.5 million of those subsidies to offset our drilling of our Maverick 1 well coming up later this year. So a little bit about the Beetaloo at the high level. This, again, is a world-class shale gas basin, similar in scale and quality on the reservoir properties as the Marcellus Shale. You can see it's situated about 400 kilometers just south of Darwin. It's connected by infrastructure where there's existing pipelines, particularly the latest Northern Gas pipeline that was constructed by our partner Gemini in 2018. That's the only pipeline connecting the Northern Territory to the East Coast gas market. I've already mentioned there's low emission gas characteristics of the Beetaloo on the order of 2 to 3% CO2 in situ to the reservoir. So again, the potential for cost effectively offsetting that carbon. So when we can produce a net zero gas stream. And again, there's very strong alignment at the Northern Territory state level and at the federal government level. And I will note, this is election season, and this is a bipartisan support at the federal government level around developing the Beetaloo. I think addressing one of the initial questions, what you see here on this slide is what's called a spider diagram. And what this shows in the lines in gray is the key reservoir properties for the Marcellus Shale. You can see on porosity, gas saturation, TOC, clay content, all line up very similar to the Mid-Valkyrie B Shale that we'll be targeting in the Beetaloo. That's shown in blue. The only key differences between the Marcellus and the Mid-Valkyrie B is, again, it's about 60% thicker, about 50% deeper, so very higher pressure. And then importantly, 80% more gas concentration, otherwise known as gas in place. So this 200 BCF per square mile, I think, out of all the reservoir properties on this page, really get our team the most excited as it relates to the potential for producing very high gas production rates per well and very high reserve recoveries per well, which will translate into very premium economics on a margin basis. So getting into where our two assets sit in this Beetaloo Basin, the map you see on the left of this slide is indicative of the depth of the Mid-Valkyrie Shale. As you get into deeper shades of blue, you get deeper and deeper, ultimately into the Epicenter, where both of our assets sit. Epicenter in any shale basin is, where you see the highest rock properties of anywhere else in the basin. And in addition, it's where you see very high pressure. And it's also what I call calm geology. So you don't have any faulting. It's very contiguous layer of shale that we'll be targeting, which is ideal for development as it relates to drilling horizontal wells without incurring a lot of compartmentalization as you cross faults. So this is, again, one of the reasons why we have focused our asset mix in this core area. This is where our primary asset, EP136, is situated. This is where the company has 100% working interest and operate. We have also had this block assessed by Netherland and Sewell independently at 19 TCF. That's over 330,000 acres. So you can see over that 330,000 acres in EP136, which takes us down from the deeper shades of blue to the lighter shades of blue in the map on the left, encompasses all that 19 TCF. And the really exciting part of this EP136 block is we've had over $120 million spent in the area by Santos and Origin over the last 8 months. There's 2 wells that we've participated on EP161 called Tamboran 2H and Tamboran 3H that were drilled late last year and that we've now been flow testing coming up on 90 days. Again, Tamboran is a 25% on a non-op to Santos. Santos has 75% and operates EP161. This drilling occurred right to the north of our EP136 block. And then to the southwest of EP136, Origin Energy and Falcon Oil and Gas completed a well called the Valkyrie 76S2 well. This well was a vertical well. It logged a full column of Mid-Valkyrie B Shale. And together between the Valkyrie 76 well, Tamboran 2 and 3, there's been a significant de-risking that's occurred in this part of the basin that really sets up for a very exciting well that we plan on drilling this year called Maverick 1, kind of right in the heart of the core Beetaloo. And it's a well that we plan to spud in July, August timeframe. And we'll look to report initial flow test results to the market in fourth quarter of this year. So one of the other reports that we've had Netherland and Sewell progress on the company's behalf is a reserve maturation study on our drilling plans over the next 24 months. So the map on the left, you can see the colors, by the way, are indicative of 1P, 2P, and 3P reserves matured as each well is drilled. So for Tamboran 2 and 3, you see the collection of 1P, 2P, and 3P reserves that were booked. And then the Maverick 1 well that you can see that we're planning on drilling on the lease line of EP 136 and 161. What's really exciting as we move into 2023 as follow-up to Maverick 1, we plan to drill 2 additional wells, Maverick 2 and Maverick 3 on EP 136. In addition, Santos is planning to drill Gibra South 1H. It's at the midpoint between Maverick 1 and Tamboran 2 and 3. And so collectively, with these 3 incremental wells planning to be drilled in 2023, there's a nice envelope of 2P reserves in blue that get matured over both of our blocks. The one in particular, the EP 136 block, where we have 100% working interest and operate, we look to mature up to 2P reserves of a TCF on our EP 136 block only. In parallel with this drilling, the company will be progressing, signing a gas sales agreement with a buyer on the East Coast market to secure a gas sales agreement that for 100 TJs a day for 20 years, that will be supported by this 1 TCF of 2P reserves. And that will bring forward a pilot development sanction that we would look to complete by the end of 2023. So as we book these 2P reserves on EP 136 of a TCF, this really provides a pathway for the company to grow from around a $210 million market cap that we trade at today to over $1 billion market cap, as you can see on this chart, where it compares, other significant 2P reserves transactions that have occurred and comparables in Australia today, including the most recent Cenex POSCO transaction, which transacted at about $1 per MCF. So when you take that $1 per MCF and roughly match that against our 2P reserve number of a TCF by the end of 2023, you can see it provides a pathway to over $1 billion in value, which is it's about 5 times the value of what we trade at today. So let me stop there and turn it back over to Tim to address any further questions on the last section.
Thanks, Joel. You mentioned some big names out there, your partnership with Santos. You also mentioned Falcon Oil and Gas. Are they on your register at all?
No, Falcon Oil and Gas are not on our register. They're a company that is a publicly traded company on the London main board exchange and on the Toronto exchange. They trade at around $140 million market cap. Gotcha. They're a non-op to Origin, to the acreage to our west. So they have 22.5% interest of the acreage to our west.
And just going back a little bit into the terms of the Beetaloo Basin, is there any environmental concerns in regards to how you treat water and kind of minimize land disturbance?
Yeah, absolutely. So for everyone on the call not familiar, we've had the Beetaloo Basin went through a fracking moratorium as a Northern Territory state government for about a 24-month period beginning in 2017. And following the results of that moratorium, the Northern Territory government put in place new regulations really geared toward, protecting the water is one of the key pieces to the legislation. And so one of the things that, to address your question, that every operator has to do out here in the Beetaloo is prior to drilling any well, there's a water monitoring bore that gets drilled to monitor the quality of the water before and then after we drill the well to ensure there is there's no impact to the water. So that's one of the pieces of regulation that every operator has to do as part of any drills that occur in the Beetaloo. The other thing I'll say is that where we're going to be drilling in the core area of the Beetaloo is about 3,500 meters down below the surface, so around 3,000 meters from the water table. It takes us about 60 days to drill this very hard rock. So there's, it's next to 0% chance for having any impacts for our fracking operations that will be occurring at around 3,000 meter depth to where the water table sits, which is about 150 meters from surface. The other thing that the company is progressing is one of the opportunities that we see in the Beetaloo is bringing in a U.S. rig capable of drilling very long laterals on the order of 3,000 to 4,000 meters. The current technical limit for drilling horizontal wells in the basin today, in the area where we're focused, is around 1,000 meters. So by being able to drill longer laterals, 3 to 4 times as long as the current technical limit, will allow the company to recover 3 to 4 times as many reserves per well, and will reduce the land impact quite significantly by drilling off one pad and being able to drill multiple 3,000 to 4,000 meter laterals from one pad. This is, on the order of 20 to 30 times less of an impact in the Beetaloo than what you see in CSG in Queensland. So we think that's significant and something we're going to be really focused on in the next few years, and being able to bring forward a solution that will limit our impact to the land relative to other developments in Australia.
And is there any local community issues that you also have to be mindful of?
Look, consultation is ongoing. Stakeholder management is something that our company is very focused on. I know other operators in the area, like Santos, Origin, Empire Energy, all of us, in my view, do a great job around stakeholder management. Keep contacts for us or the NLC, which is the Northern Land Council. We have regular contact with the Northern Land Council, and then pastoral lessees that own cattle farms in the area. We're in regular contact with our pastoral lessees over our property to ensure we take on all comments and make sure that we listen and we adjust our plans accordingly. And an example of that is we had a 250 kilometer 2D seismic commitment that the company had that we were planning for this year. And after listening to consultation from various stakeholders, we reduced that 2D seismic shoot from 250 kilometers to 90 kilometers. So we reduced that really just to de-risk the well location for Maverick 1 and the related pad that we'll be drilling. So it's not just a matter of having meetings, and it's really taking on that feedback and putting that feedback into action.
And you've spoken about strong federal government support, given they're recognising the emerging gas shortfall on the East Coast. What could that mean for Tamboran?
I mean, look, there was $50 million in grants that were allocated to operators to take advantage of to offset drilling up to 25% of drilling cost. We're taking advantage of that by having $7.5 million awarded to us by the federal government that will offset our Maverick 1 well. So that's certainly well appreciated. The other one that I'll mention, again, led by the federal government, is $1.5 billion of commitment related to infrastructure in Middle Arm and right outside of Darwin. And this $1.5 billion will go toward potentially a multitude of infrastructure. It could be allocated for additional LNG trains that will support additional LNG flowing into the Asia Pacific market. Again, we would envision that being supported by Beetaloo gas. There's also talks of using, that $1.5 billion for urea plants, fertilizer plants, potentially looking at hydrogen as well. So, we look to take part in that. And that's something that, I think we welcome, initiatives that the federal government are bringing forward on infrastructure, because one of the ways you accelerate the initial development of the Beetaloo is ensuring there's adequate infrastructure to flow to from pipelines, but importantly, have opportunities to progress outside of the domestic market and the LNG backfill market as well.
And Joel, just one more question before you continue. You're well funded. You got $55 million on the balance sheet as at the 31st of March. How will you look to fund next year's program?
So that's a really good point. So we're fully funded for Maverick 1 this year. That's again a well that we plan to spud in July, August timeframe and have flow test results by end of the year. One of the opportunities that the company is progressing is looking to potentially look at farming down our interest in EP 136 to fund our Maverick 2 and 3 wells. So we've kicked off that process. We do have ongoing discussions with various companies around that. And, I think we'll look to look at that as the primary financing option for Maverick 2 and 3 after we get the results of Maverick 1. So sort of we would target in the first quarter of 2023 to work to finalize a potential farm-in transaction with a third party.
Thanks, Joel. I'll let you continue with the presentation.
Great. So one of the things I want to talk more specific about is the recent results that the company have from Tamboran 2 and Tamboran 3. This again, the 2 wells that we drilled on our EP 161 block, where we have 25% interest, and Santos is 75% working interest and operates. Each of these wells were drilled to around 3,000 meters in vertical depth, and then 1,000 meters horizontal into the mid-Valkyrie Shale, primarily in the B Shale. There's really 3 things that really we walk away from these results in a very positive posture. First is we were able to achieve out of each of these 2 wells around 3 million cubic feet a day as it's normalized over the full 1,000 meters of lateral. Our view, this is, this was 3 million a day from an unoptimized completion design. The more we look at this, more that we see the potential if we incorporate a what I call a U.S. style completion design. These wells have potential to flow upwards of 5 to 10 million a day out of 1,000 meter lateral. So these results get us real excited about our Maverick 1 well that I'll talk about the design here in a minute. The second thing that really I think was a positive for these 2 wells is, you can see the seismic line here on the slide, is that as we drilled into the mid-Valkyrie B section, again, this is the section in the core Beetaloo that looks very similar to the Marcellus Shale. We drilled 1,000 meters into this mid-Valkyrie B Shale, and throughout that 1,000 meters of lateral, we saw very significant gas flows coming in the well. And what this, from our team's perspective, this was indicative of natural fracturing throughout the shale section. And so this was, when you look at some of the most high productivity wells in the Marcellus Shale in Pennsylvania, wells, flowing 30 to 40 million cubic feet a day out of one well. These wells were targeting shale with natural fracturing. So we're very pleased to see this as we move horizontally through the shale section. And then the third thing that I would say we take away as a key learning is, we see these wells being drilled for about 100 days per well. And it really shined a light on the lack of adequate equipment available to operators here in Australia. So we see a real opportunity to bring U.S. style, rigs, completion equipment from the U.S., equipment that's designed to drill deep shale wells in a very efficient manner, to be able to reduce drill times by up to 50%, and importantly, be able to drill up to a 3,000 to 4,000 meter lateral. And so we see there being opportunities there, and we'll be looking to update the market on, potentially looking to source a rig from the U.S. in the coming months ahead. So the strategy for Tamboran all along was to participate in drilling on EP 161 on Tamboran 2 and 3, learn from these two wells, and then take those learnings and deploy those learnings into our operated acreage on EP 136, again, where we have 19 TCF and we operate. So you can see the well design that Santos put in for Tamboran 2H and 3H on the top of the page. Again, both 1,000 meters of lateral, 3 million cubic feet a day, normalized over this 1,000 meters. Tamboran 2 had 10 stages. Tamboran 3 had 11 stages. And so if you think about frac intensity on a scale or on a dial from 0 to 10, frac intensity in our team's opinion was turned to about a 2. And so for all the golfers on the call today, that's sort of, in our view, kind of equivalent to hitting a 5-iron off a par 4, 400-yard par 4. And so by just putting it in the middle of the fairway. What we look to do differently in Maverick 1 is drill the same 1,000 meters of horizontal section into the mid-Valkyrie B, but we're going to look to pump up to 3 times as many frac stages, or around 30 stages over this 1,000 meters, and really turn the dial from a 2 to a 5. And we think there's potential to see rates at 5 million cubic feet a day per 1,000 meters or greater. And then as we move to Maverick 2 and Maverick 3, and as we get into the pilot development wells, where we would envision well designs to be drilled on the order of 3,000 to 4,000 meter lateral, we would envision up to 100 frac stages and really turn the dial from a 5 up to a 10. And this is what I would characterize as a latest generation Marcellus well. These are wells, again, that are producing today in naturally fractured shale, very similar to the mid-Valkyrie B and the Beetaloo, and have seen rates of 25, 30, 40 million a day. And so this what gets us really excited about the potential for these long laterals to recover, up to 20 BCF out of one well. That's about 20 times as many reserves that you would get out of a normal CSG well. And then deliver, very high productivity rates, so that for only 10 or 20 wells, you would be able to build up to that initial 100 TJ a day type production volume. So again, being able to progress this pilot without, disturbing the land, we're only talking around 2 to 3 pads to deliver this pilot development using the well design on the bottom of this page. So let me stop there. Again, Tim, over to you to take any questions around the well test or well designs that we're envisioning moving forward.
Yeah, there's a couple of technical questions here. So why did someone like Santos only kind of frack to the level 2?
Look, I can't speak for Santos. I think that would be a question for them. What I will tell you is that, the well design for Maverick 1 is what we were we were talking to Santos on as it relates to designing Tamboran 2 and 3. There's a wide range of rationale on why Santos pumped what we would characterize as a 2. But again, I would leave that for Santos to answer. Obviously what we can control is how we design our wells moving forward. On EP 136 on Maverick 1 and beyond.
And what gives you confidence in achieving that kind of 5 million standard cubic feet per day?
So again, what the learnings that were taken from Tamboran 2 and 3 give us a lot of confidence. There's a couple of the frac stages that are performing better than others based on tracer information that we had gleaned, from both of these wells. And when we take that tracer information and extrapolate, what I would say to be a very good frac stage, each frac stage was, that was out of the 21 stages that were pumped between Tamboran 2 and 3, there were probably 3 or 4 stages that were pumped, in our view, at U.S. kind of standards. If you take those stages that were pumped with, the increased frac intensity, they were producing about, 600,000 scuffs per day, per stage. And so if you multiply that by 30 over 30 stages, you get a minimum of 5 million cubic feet a day or more. And so again, it's based on real analytical data that we're, gleaning from these well tests on Tamboran 2 and 3. And again, this is sort of our intellectual property that, that we've developed through the participation of these 2 wells. And that, again, we can incorporate that over 30 stages in Maverick 1, which, if we're able to get away, the all 30 stages at a level 5 type frac intensity, then we should have a pretty significant well, minimum of 5 million cubic feet a day.
Thanks, Joel. I'll let you continue the presentation.
Great. So what I want to do now is really take, these recent well results and then really answer the question of, how this translates into project economics, particularly on a margin analysis on each one of our target markets for our pilot and our full field development. So again, as a frame, we've been working over the last 2 years to develop a joint venture with Jemena, who is the second largest pipeline company here in Australia. Jemena is the 100% operator of the Northern Gas Pipeline. This is a pipeline that they constructed in 2018 for $800 million. This pipe has a capacity of around 100 TJs a day. And so our target for our pilot development will be to access this Northern Gas Pipeline and work with Jemena on adding compression to this pipe that will increase the capacity from 100 TJs to 200 TJs a day. That will therefore give us, incremental capacity to flow our pilot development through this pipeline and into the East Coast gas market. The dotted line that you see on the left map is the indicative pipeline route for a bigger pipeline that Jemena would envision being a 36-inch line capable of producing up to a BCF a day. And we would envision this pipeline giving us access to producing, up to a BCF a day to Darwin by the end of this decade, or to the East Coast in Willombilla. That would give us access to both the domestic market and 3 LNG plants on the East Coast. So one of the things that we've worked with Jemena on is to break down the potential cost that we could deliver gas to each one of our key markets through time. So starting out with our pilot development that we're focused on developing the 100 TJs a day by 2025, we're going to be targeting upstream costs that includes CapEx and OpEx at the wellhead at around $2 to $3 per gigajoule. And then accessing this Northern Gas Pipeline and into the network to the south of that pipeline, there's about a $4 tariff that would take gas from the wellhead in the Beetaloo to Sales Point and Wallumbilla. And so you can see all-in cost of around $6 to $7, which I think is a conservative cost to get our gas to initially to market. Again, the current gas prices in domestic market today are around $15 to $20. We've run all our economics at $10 flat gas price. So it's even at $10 gas price, we're talking about $3 to $4 margin on our pilot development. Then moving into the full field development, again, this would assume a 36-inch pipeline new build that would connect us either to Darwin or to Willombilla. We would envision additional learning curves that would result in our upstream costs coming down around $2 per gigajoule or lower. And then, the midstream tariff that Jemena has contemplated would be $2 from wellhead to Willombilla, and then 50 cents into Darwin. So If we assume 50 cents transport into Darwin to the inlet of an LNG plant, that's $2.50 into the inlet. And then if we assume $2 liquefaction and then 50 cents shipping from Darwin to Japan, this would equate to around $5 Australian gas delivered into Japan by end of this decade, or around $4 US LNG. So this would make this gas some of the lowest cost gas in the world, in the bottom quartile on the cost curve, all gas supplies moving into Asia today. So one of the sensitivities that I'd like to share with everyone is around where we sit today on this upstream cost curve, and then where we're looking to go into our pilot development and for our full field development. So what you see on this chart is on the y-axis, development well cost ranging from $10 to $40 million per well, and then on the x-axis you see incremental rates for 1,000 meter horizontal translated to a 3,000 meter horizontal, and then ultimately the reserve recovery per well. And so the numbers in the matrix in the chart are indicative of CapEx and OpEx, so total upstream cost. And so you can see today, based on the 3 million cubic feet a day result that we got for Tamboran 2 and 3, you can see we're sort of sitting right on the commercial threshold of around $5 to $6 upstream. And everyone remember the $4 midstream, that puts us, very marginal economics in a $10 gas market. So where we see opportunity in around drilling 3,000 meter laterals, being able to drill with modern US style equipment, we see the potential to move into the upper right-hand corner of this chart, which would be sub $2 upstream costs. Our target is ultimately to drill wells here for less than $20 million per well. This is again assuming modern US style equipment, and then 3,000 to 4,000 meter laterals, and that will allow us to increase our reserve recovery per well from 16 to 20 BCF recovery out of just one well, and that would match us to put us in this space of sub $2 upstream cost. And this has happened before, and so when we look at all of the U.S. Key shale basins over the last 12 years, each of these basins have all seen reductions in drilling and completion cost of up to 50%. What our team will be working on is really adopting these learning curves at the end of each one of these curves. Over the same time period, we've seen productivity per well increase by over 100%, particularly in our analog, the Marcellus Shale, shown in green. We're going to be looking to do the same thing in the Beetaloo as we progress into the pilot and ultimately into our full field development. So to finish up, this is kind of our plan for 2022. We're going to be focused primarily on drilling our Maverick 1 well. Again, this is our 1,000 meter horizontal well that we plan on drilling on EP 136 this year. Target spud of July, August timeframe, which would put us in initial flow test results by the end of this year. With success, we would look to make a 2C contingent resources booking on EP 136, and also progressing with Gemini around feed studies or development planning studies that will look to develop our plans around infrastructure to support our 100 TJ a day pilot development. In addition, we're planning to continue to flow test Tamboran 2 and 3. Santos intends on flowing these wells up to 300 days. And that's really positive, given that we'll be able to further evaluate the ultimate decline that we would see over that 300-day period. That will, further inform the company around what a type well would look like for development for our pilot. So very positive that we're going to be flow testing for over 300 days. And then, of course, we're going to be progressing as we get the results to Maverick 1. We're going to be progressing the Maverick pilot development so that we're in position to sanction that project by the end of 2023. So let me stop there, and we can address any final questions.
Thanks, Joel. I know it's late over there, so we've just got a couple for you. You were talking about kind of modern US technology coming into the region. Can you give us an example of something like that?
Yeah, I mean, I think the well designs that we're planning for Maverick 2 and Maverick 3, and then our pilot development wells that you can see on the bottom part of the slide, is a great example of this US technology. You know, longer laterals, frac intensity to a 10. A lot of this is more horsepower, more proppant concentration, more frac stages. So this is, again, intellectual property that we'll be looking to develop with Maverick 1 well, and then look to deploy additional learnings as we drill more and more wells. I think another aspect to how you bring in US technology, I think a lot is to do with your development plan. So again, we've been working with Netherlands Sewell around really positioning our wells in a configuration that maximizes our 2P reserve booking. So we're not just drilling wells and in the same location. We're given very optimal spacing so that we're very capital efficient, so that when we drill our 3 wells, they're done in a way that by the end of drilling that 3rd well, we could be in position to book a TCF 2P reserve. And so a lot of that on EP 136 we can control, but we're also working with our partner Santos to position that Gibra South well, again at the midpoint between Maverick 1 and Tamboran 2 and 3, and that will optimize our 2P reserve booking, not just on EP 136, but across the 161 permit as well.
And earlier in the presentation, you spoke about, $400 million worth of revenue around 2025 based on a $10 gas price. Where's kind of gas price, or the spot price, trading now? And is there any expectations for high gas prices?
Yeah, look, Willimbilla is the probably closest spot price in Australia. And I think last that I've seen it, again, evening here in New York, but last I saw it was around $17 to $18 a gigajoule. I think, again, with lack of new investment in gas in the country, I think that is likely, these high gas prices are likely to sustain in the midterm, which, we can't predict what gas prices are going to do, but this is why we use a kind of a conservative $10 gas price for our pilot and $8 for our full field development. But, we'll see. We'll see. I think it's a buoyant market. And again, the macro has definitely shifted in our favor. And I think that will continue as we move along in the next few years.
And Joel, just finally, you have an astute institutional register, and the stock is well held by management. What are retail investors missing here?
Look, that's a good question. It's one of the reasons why we want to do seminars like this, is really get our story out. I think through the IPO, and even before the IPO and the pre-IPO, the primary marketing was to long-only institutional investors. And the good news with that is they're long-only, and they will be holding the stock for a long period of time to see the full value be realized in the company. The flip side to that is that there's a whole retail piece that did not come in the pre-IPO, and that we've been looking to develop since the IPO. And so we'll continue to do that. We have relationships that we're developing on the retail side. We're looking to bring forward coverage. I know Share Cafe is in the process of putting in coverage. There's a few other banks here in Australia that will be picking up research as well in the next few months. And so, look, this is a key challenge, and but we're up for it, and we're going to continue. We think we have a great story. Again, I think this is one of the most exciting energy growth stories here in Australia equity market, and I think through time, I think we'll eventually get some really good liquidity in our stock built up from a retail penetration.
Great, Joel. That's all we have time for. A real pleasure having you present from New York. We appreciate it. It's late at night there. A great story. We have some research coming out in the coming weeks, and we'll be sharing that with our audience. So thanks again for your time.
Great. Thanks very much.
Thanks, everyone. We'll be back another time with another due diligence webinar. See you later.